Good one.
Hello, traders, warriors. You have to be a trader, don't you, Callum? You have to be a warrior.
Yeah, you have to be both in the warfare sense and in the worrying about things sense.
Yeah, not a warrior, a warrior. So I'm both. I'm
Exactly.
worried. I'm a worried warrior. So
Yep.
everyone, Callum Thomas, live from New Zealand, correct?
Yep. Yep.
All right, you know that. Ever hear of a guy named Martin Armstrong, the guy with
I've
pi?
yeah, I've heard the name.
Okay. Well,
Yeah.
he's talking about the U.S. as being Rome near the end of the Roman Empire.
Right.
Sees that kind of thing going on. And, during the Greek debt crisis, he was talking about sovereign debt crisis. And I asked him, I said, well, if all of this is going down, Marty, where would you want to be to ride out a storm? And the two countries he mentioned was New Zealand and Scotland.
Mm. Yep.
So,
Well,
yeah,
geographically, we're that far away that most people kind of forget about us, and
yeah.
that can be a good thing.
Yeah, a real good thing. People
Mm.
are the problem when it
Yeah.
comes down to any kind of social fabric stuff. And I know you guys have
Yeah.
had your stuff there with
Well, that's the
earthquakes,
thing,
and
yeah, yeah,
there's
and
always,
we've got our own sort of the political pendulum swings over here as
well,
well, and so you're never gonna
yeah,
unless you go over to the moon or Mars, you're never gonna really escape the people issue,
yeah,
you
yeah.
know.
So
Um,
where's New Zealand swinging to the right, like the rest of the
yeah,
world?
yeah. So
Okay,
we had a big hard swing to the left during the pandemic, and then the pendulum naturally swings back
yeah,
as you expect.
okay.
And I think,
So
and as we're seeing globally too, I'd say that, and I think that's one interesting thing about New Zealand is that we tend to be a sort of a microcosm. We're a little, sometimes ahead of the curve or a barometer of what's going on around the rest of the world as well.
interesting.
Certainly we saw that with monetary policy.
Okay, so
Mm,
that yes, and love the way your currency is acting. I'm very bullish commodity currencies. I've been talking about the long side of Canada for since the crash that we had, the
mm,
flash crash Monday.
mm,
I was a little early, but I think they have a real nice look going forward for quite some time now. I think that's the
mm,
biggest event we've had. You could talk about the
mm.
stock market, but the fact that the dollar
Yeah.
has spoken
Mm,
and what it said was it's breaking down, I think is
yeah,
going to have repercussions across all the markets for many years to come.
definitely.
So what I want to start off with you is how did you end up in the financial trading business? Did you know it was something you always wanted to do when you were younger?
Mm,
Did you train for it in school?
mm.
Who do you have to blame for you getting involved in this, Cal?
Yeah, that's a good question. I think it was my uncle or cousin. No, he's so like an older cousin. And
Okay.
when I was about 10 years old, and I was the kid that was always doing sort of little entrepreneurial things, selling things door to door and that. But I kept on looking in the newspaper, and you'd see the stock market page, and uh, it just sort of kept on grabbing me. It's sort of like I knew that there's something there, and
Uh, yeah.
my dad happened to mention it to my older cousin, and he sat down with me and talked me through all the sort of goings on of the how to invest in the stock market, and gave me a book, and I read that book cover to cover a couple of times, and
What was
read
the
many
title?
books.
Do you
It
remember?
was something like Making Money in the Share Market, and it was a New Zealand book.
Okay.
Oh, so that's a good question. I might have to try and dig that out. I might have to go and reread it because sometimes I think it's you read a book, and you've got a certain set of mental references that you can kind of relate
Yeah.
to it. And then if you go back and read it 10 years later, it's like a whole different person reading the book. And by the time you've
Right.
changed your thinking and collected your experience, and so it's a good idea actually. But yeah, from there, sort of drifted towards a career, gravitated towards a career in investing, and first job was it was an economic analyst at a fund manager, and I basically found out from that I really enjoyed the research side of things. And so, I think when you're going into investment management, you can, yeah, I mean, you can do both, but research and portfolio management are two different skill sets. Taking risk versus, going out and doing the work. And, um, I think if
Formulating
you,
a narrative and trading it are two different things, aren't they? Completely.
exactly. Yeah.
Yeah.
And the moment that you start taking risk, then that really blurs how you see the world, the moment you take a position. And so that's why, I basically don't trade because, my job is to go out and look at the world and see it with as clearer eyes that I can and, take those insights and work with portfolio managers you know, to support
Okay.
them in their decision making and their taking of risk and you know
So you see
um
the market clearer if you're not trading.
well, the moment you take a position, you have an
Yeah.
interest in
Yeah. You have a
that
bias.
exactly, yeah,
Okay.
and so you want the thing to come true in many senses. And I mean, I guess that's the thing is, as a risk taker, is that you have to actually be aware of those kind of pitfalls, and, manage your psychology around that. Is that, it's very easy to get, um, not just monetarily invested, but mentally invested in a certain, um, desired outcome, or you know you form a theory of where the market's going to go, and you become
Yeah.
wedded to that view.
I think one way to overcome that is to look at the bull and bear case of whatever you're looking at.
Yeah,
Know the other
absolutely.
side of the trade. So if evidence start to pile up for the other side of the trade, at least you're aware of it and not
Mm,
just considering it aberrational, like the S&P chart, for example.
yep.
Initially,
Mm,
down there, I talked about the possibility of another new high for a third drive to a top, but initially it could have also just been a failing rally before
mm,
what it did in the last 2 or 3 days.
mm,
So new highs look like a layup from
yep.
here,
Exactly.
which
Yeah, we're
makes
we're not that far at this point. We're about
yeah,
what,
which
1%
make
away.
I can't think of one reason to be short, which makes
Yeah.
me
Well, to
want to be short because they're
yeah, exactly.
what
Yeah,
I'm
and that
saying?
immediately so makes me think, okay, well, if we've got this view, well, what can go wrong? Let's go back to the being
Okay.
a trading warrior in the worrying sense.
Yeah. So
Is that, there is a bit of like that. Okay, so that chart's actually, so this one's. Can you see these charts?
yeah, we've
Yeah.
got the S&P chart. I wanted to ask you, so when you were progressing in your career,
Mm,
obviously with your business model, you gravitated towards technical analysis. Did you have any mentors yourself in charting or any books that left a big impression on you in your
mm.
technical work that you had epiphanies and you
Yeah. So, um, I mean, technical analysis is one thing I look at, but it's I explain how I approach things as building a puzzle. So,
okay.
technical analysis is definitely a key piece in that puzzle, and the different aspects of technical analysis are pieces of that puzzle. But then I also say, if you're trying to make a puzzle and you only have one piece, it's pretty hard to figure out what the picture is. And so I say, we should also be looking at valuations. We should be looking at monetary factors, financial conditions, the cycle, whether that's, earnings or supply cycles, issuance cycles,
How about
sentiment.
correlations? Like here's a
Mm,
puzzle.
yeah.
Bonds and yields.
Mm.
are forecasting a recession. The market doesn't seem to be doing
Uh,
so, and
I
the
wouldn't say
dollar
that.
breaking down.
Yeah, I wouldn't say where bonds are at the moment. They're forecasting recession. The Yeah, I mean, it, I would say if bonds were at 3% or below, then they're forecasting or
Okay,
reacting to a recession. We're probably in recession at that stage if they got to that level. Um,
okay.
yeah,
I mean, to me, this was a pretty dramatic
mm.
drop in yields from
Yeah, and
470
it
to
does speak to
370.
the point that the discussion or the yeah, earlier in the year, recession risk wasn't really on anyone's radar, but now I think it's kind of like, well, I did a survey recently, 30% of people are saying that that's the main thing that they're worried about. So yeah, would definitely agree on that side of things. But also just like the inflation outlook, so commodities, you know, taking a bit of a slide there is obviously helping things along
Do you mean
on the bond front.
the oil and the industrial metals? Because wouldn't you
Mm,
say that gold? What's gold forecasting,
yeah,
Callum?
well, gold. I almost say you should. I mean, gold is definitely a commodity, but then it's a very different commodity in terms of what drives it from the macro standpoint, and the psychology around it versus the rest of commodities, which
Like
generally most of the
copper?
rest of them are a bit more economically sensitive.
Yeah,
But what gold's
copper.
forecasting, so breakout in gold, which I think we've got a chart down here in the end. It was the bonus chart at the end of the chart storm.
Because
It's a
I
fourth time lucky
remember
for gold.
I assume you also look at market correlations and how they
Mm.
bonds are doing this, gold is doing this, the dollar
Yep, absolutely.
rates. And a long time ago, I met Larry Williams, the guy who wrote that book,
Mm.
How I Turned 10,000 into a Million,
Yep.
and he's still around. He still
Mm.
publishes from the Virgin Islands, but he said that it wasn't healthy for
Mm.
the gold to rally with the market, that it was all kind of a metaphor for the market
Mm.
not being well, that it had a temperature
Mm.
and it
Yep.
wasn't healthy. What
Yeah,
do you
well,
think of
that
that?
exactly. So if you think about what's driving it here is so no, yeah, normally, and I think a lot of people had been posting a lot of charts around, gold normally travels with real yields, but there had been this big breakout or disconnect, basically decoupling from real yields. And so now it's really a whole set of other issues that are driving it. So recession risk, I think, definitely is making its way into this one. The fact that bond yields have peaked, the dollar's peaked, but I think there's a lot of other sort of narrative-y, thematic kind of stuff tied into it, like the government debt issue, with
Okay,
the deficit kind of growing, debt growing,
okay,
politics, political risk itself, geopolitical
yeah,
geopolitics is definitely a big part of it. I
big
mean,
part.
if we didn't have, Ukraine to a certain extent, obviously that thing's just bubbling away, but Middle East, we've got the Iranians there saying that they're about to, they're
Yeah,
going to get some revenge and they probably will. And they've
they
said
said
that time's on
tomorrow.
their side.
Tomorrow.
Well, they said that time's on their side and, you
Yeah.
know, the more that they wait, the more that everybody gets complacent and it's costly to maintain this kind of false posture of having all your jets and
Oh,
things flying around and so yeah, but that's just something that's hanging over the market there, um and
would the
how do
market
we
sell
deal with
off
that? We
for?
price it into gold and
Yeah.
and
Would
bonds
would the
maybe.
market sell off for a day and a half on a regional war and then rally to new all-time highs? What would
Well, that's
happen
the
if it
that's
broke
the
out?
problem, with the when you get the geopolitics stuff is that a lot of the time, uh, except for 2022, but um, we'll talk about why that was such a big issue. So a lot of the time, you get these geopolitical events flare up, and market has a little bit of a a panic attack, and then that ends up actually being a healthy reset in sentiment, and it goes on to new highs. But I think what I always try to do is say, okay, I can't really guess what some military leader is going to do, but I can look at the market conditions and say, okay, um, zooming out a bit for the stock market, valuations are expensive. We've got interest rates still at all-time highs, like well, multi-year highs rather, and we've got economic signals quite mixed. The K-shaped economy where parts are strong, parts are weak, and
Yeah.
that represents a vulnerability. And then we've got sentiment positioning. Actually, we can look at
Yeah.
those charts there where everybody's all in. We're late cycle. And so
Yeah.
it's that kind of starting point where if you did get some kind of geopolitical risk flare up, that the market is particularly vulnerable to that. And in that sense, it's like, okay, I'm taking a defensive stance because of these existing conditions. And if we do get this geopolitical flare up, which it kind of looks like we will, then that's just one of a list of potential catalysts that could make it happen from a timing or a tactical standpoint. But you almost want to be have some defensive positioning ahead of it because God
What
can
was
move pretty quickly. And
what?
that's
Go ahead.
yeah, that's what the parallels were with 22, where you know it was like, oh yeah, whatever, another geopolitical flare up, with the Russian invasion of
Yeah.
Ukraine. But then it was from a starting point of 2021, we had that crazy stimulus fueled
Right.
party in markets where valuations were very high and sentiment was very bullish. And, um, both stocks and bonds on my indicators were showing up as extremely expensive. Meanwhile, commodities were showing up as cheap. And so, it was like this perfect storm where there was all these pressure points building up, and that was just the trigger. Um, and then, of course, there was the initial fact of it, but then there was also the reaction and the flow and things that you kind of can't necessarily predict. Like, who would have thought the natural gas prices would have done that, and
Right.
that we would have had this inflation shock from that, which, that's the reason why um, it is just a sort of an known unknown, or that, you know, okay, maybe it's probably just they throw some bombs over here, they throw some bombs over there, and things kind of work themselves out. Or maybe it does, trigger off some other stuff that we can't kind of think about yet. What happens to oil?
Yeah.
Those are sort of the unanswered questions on that front.
Yeah. So oil to me looks like
Mm.
we're in this huge triangle, and I was
Mm,
thinking that
definitely. Yep.
that
That's high on the radar, that.
is
And
it
and same thing with the dollar. The dollar has actually begun to break out of that one though.
oh yeah, the dollar,
Mm,
the next battleground, we're almost there at par.
yep.
But the Dixie under par,
Mm,
I have all
yep.
kinds of downside targets there.
Yep.
So
Yep. Definitely.
you also talk about how they say that it's mainly the 1-2 percenters that own stocks and assets, and that's why they're doing well. And you have a chart in your stream that shows U.S. households at record long equities as a percentage of financial assets.
Yeah. I'll see if I can
And
bring that up. That was
so
from a few days ago,
that's
wasn't it?
like everyone's in the pool.
Yes.
If
I thought that
so
this is one of my most favorite charts at the moment, actually,
yeah, that's the one I'm talking about. Yeah,
exactly, yes. And what I find interesting about this is that so we've got two really important lines there. The blue line is that US household holdings of equities basically at record highs, and it does we find confirmation of that in other surveys, other data sets, and yeah, um, the 1% obviously has a little bit more than the rest of us, but it's
what what's 6 zeros?
right,
Callum?
exactly.
Right, they're only digits.
Yeah.
So I mean,
And
look, it really
mm,
took almost 20 years
Mm,
since the dot-com bust,
mm,
for these levels to be taken out, the dot-com bust highs. That's the last time
yeah.
we
And it
really
also
had that
speaks,
kind of, right?
yeah, and it also speaks to the point that the black line there is the PE ratio or evaluations, and it speaks to the fact that, how do you drive up valuations? You do that by people buying stocks, which they are, and that's why I always think, valuations, um, they're market timing or a market cycle barometer. They're also, basically a confidence indicator because if the market, if everyone's extremely confident on how earnings are going to grow, if they're confident on the outlook, confident enough to allocate that much to stocks, then that's how that's how it gets expressed in the valuation there, like just as we saw that at the peak of the dot-com bubble.
Okay.
And and it also speaks to the lack of, well, previous lack of opportunities there. So I think it was quite interesting just to see how things moved across time, like in the 70s and 80s there. I mean, you're getting, for a time there, double-digit earnings on your cash investments. So it made sense that equity allocations would be lower then. And
Yep.
then, as things have evolved then. But the other thing there is just you can clearly see the cycles. So you've got these structural changes, but you see these cycles there where people get carried away. They go all in on the stock market, become super confident, as expressed in the valuations there. Then someone comes along and ruins the party, and that's typically been the Fed. Um, and I think this time maybe people are getting impatient and saying, well, um, or explaining away. And there are reasons why rate hikes have had a lesser impact, for example, with a greater incidence of fixed rate borrowing at the lows. But sooner or later, and it has taken time, in the past for those rates
The
to
lag
kind of
effect
have
from
their
the
effect.
Fed.
Exactly.
Do
Yeah,
you
the
think
long
they're
and
behind the
variable effects.
curve? Do you think they're behind the curve, Callum? Just your belief.
I think that you can, the way that the data is moving at the moment and looking right now, I think that you can find evidence to make an argument either way.
Okay.
Um,
All right. That's
like,
what
well,
I tell you what, Fed people love being able to where you have two different narratives and they could choose which one.
yeah.
I mean, Paul has sounded bipolar to me many times. Is he going to be nice today or mean
Mm.
today?
Well,
But
over here
you know,
we had that kind of dynamic going on. The central bank over here just a few months ago said, we're disappointed with the rate of disinflation. We might even do one more rate hike, and then just a week or two ago they cut rates.
yeah,
They turned to easing. So
yeah,
and that's, I mean, we can't beat them up too much because they're basically playing the same game that we are. In the sense of their goal is not necessarily timing the market from to make money. Their goal is timing the cycle to you
yeah.
try and achieve their target. And so
Well, there was plenty of
we've got to
trading
change our
happen.
opinion as the facts change.
There was plenty of trading happening at the Fed.
Yeah, yeah, well, that's right.
Okay, so I, okay, so
Mm,
I hope you're right that it's
yeah.
not like that anymore. Uh,
Mm.
so
But
tell
going into
me,
this weekend with
tell,
Jackson Hole, I mean,
yeah,
they've painted themselves into a corner now. I mean, if they say, well, maybe we won't, or maybe we won't cut rates, or wait and see, blah blah blah, then they're probably going to be quite disappointed, I think, at this point. Um, you look at
yeah,
how the dollar, bonds, stocks,
yeah. I think the dollar's
everything's
close
trading out
to,
of that correction. It's
yeah.
yep, it's they're going to have to meet the market, I think, and if they don't, then
What's your
we'll
highest conviction directional trade? Um, I know you covered China, Japan, and even covered the agricultural commodities, which isn't a surprise being from New Zealand. A lot
mm,
of agriculture there, right? It's more than
mm,
milk, right?
mm.
I mean, people would watch milk prices to trade the kiwi. There's
Mm,
more to watch than the price of milk, right?
mm.
For the New Zealand dollar.
Yeah, absolutely.
All right.
I'm just trying to think of what the most highest conviction is. Like,
And it could be
a lot of the ideas that I have at the moment are kind of on the lower conviction side of things, which I think
okay,
is reflective
fair,
of the junction that we're at in in
fair.
this whole thing. Like, you know, if we like for example, if we look at back at the dollar, you know, it's overvalued. Like just about every currency is cheap versus the US dollar. Sentiment is starting to change, but was pretty consensus bullish.
Yeah, it
Um,
was.
Cycles wise, we're overdue for a turn. The deficit trend definitely bearish. Yield support is rolling over. Um, you know, it all points down, and then we've got this. The chart that I was really focused on was one of that again that triangle, but also just the way that US dollar implied volatility was really crunching down,
Yeah.
and so um, you know, I called that the sort of compression trade, the US dollar. So, you know, it's just getting into this tighter and tighter range. And the same thing with crude oil. It's just been really getting into a tighter and tighter range with the oil volatility
We're
index also
close to
going
we're
down,
close
down,
to
down. And it's like,
yeah, we're
I don't know,
close to
man.
the
Like,
breakdown after
exactly.
today. Very
Yeah.
close to a breakdown. That would,
Mm,
I think, give you $60 crude and eventually 40 if we
mm,
break down, which
yeah.
is so
And
counterintuitive to
yeah.
Iran, to a conflict in Iran. But
Well,
I've told
it
people
speaks
not
to
to
the
short it.
yeah, it speaks to the well, that's right. You don't want to be short. You might be bearish, but you don't want to be short necessarily because you know someone can press a button and things could, and it could all of a sudden move pretty quickly. But
Yeah,
I think this compression trade idea of yeah, and the dollar's actually starting to break out of that now. But
yeah,
the oil and bonds they broke out of that. Bond yields
right.
broke down. They were in the same kind of triangle.
Yeah, a
So I think
descending triangle in
that
the 10-year yield.
mm,
At
yeah.
It was at 420. Once we
Mm,
took out 420, measured 370. We got there.
yeah. Mm.
Um,
So
so if the
tying that like
dollar,
in terms of what you do with all that, I think that a if those all break down, then that is your recession kind of scenario. That's the okay, maybe we are actually, you know, heading downhill now, and then that flows through to the stock market because, you know, with the stock market, if we think about these investor allocations being, you know, at
yeah,
cycle highs, and we think about valuations being expensive and all the rest of it, um, you know, those things are quite easily knowable, but you know, in terms of unless you're a very long-term focused investor that can afford to just kind of wait it out, um, practically you do actually need something to happen, which is, you know, historically that's been a recession or a crisis, and you know, so that would then activate sort of downside in the market and defensive rotations. I think defensive equities look
could
very
it
good.
come from the regional banks again? The recovery in KRE has been
Mm,
nice, but I mean, we're not
mm,
close to all-time highs. It still could be
yeah.
viewed as maybe a correction. They've
Mm,
had some relief with the
mm,
duration, with yields coming down, but
mm.
I would think that some type of financial event,
Yeah. And
maybe
I think
coming
that
out of Europe. How about coming out of Europe? It doesn't have to start in the U.S. or out of China. You follow China.
yeah, China is definitely on a weak footing. Their property market's in the biggest downturn that they've had
Who's going
in
to pull the world out of recession? In '08, it was China. Who's
mm,
there to do it now?
they definitely can do it.
They
But they're
can.
really holding off. You know, normally I would have expected them to do a lot of easing by now, but I think that they're holding off. They're waiting for the Fed to start easing. I think also keeping their powder dry because they don't know what's going to happen with US politics and how they might need
Okay.
to react to that. You know, they might need to actually have a bit of dry powder in case that they end up on the receiving end of tariffs, etc. So I think that they've definitely got the um, potential to do that. I mean, the Fed too, we're sitting at these high interest rates, and that means you've got scope to actually cut. Instead of being at zero rates, you can actually cut rates.
Yeah.
Um, so yeah, and I think that that's probably yeah, but we probably need to feel quite a bit more pain for those things to happen. And then back on the bank issue, that's what I was going to say is how you like to if you wanted to think of a scenario where the regional banks run into issues that can't be quickly fixed because the last time that they ran into issues that was just because of the movement in
SVB.
bond prices and
Yep.
that was quite easily fixed by the Fed because it's like, well, the economy is kind of doing okay. Well, it has to be doing okay for bonds to be behaving like this. Uh, and the banks themselves, their credit books basically fine. So all this is just a market spasm. So we can just jump in and ring fence that. If you have recession, downturn in asset prices, and that damages credit quality, and fundamentally damages the strength of banks, and that's hard, very hard for the Fed to just jump in and you can't just wave a magic wand to fix that. That's called the economic cycle, and when it goes down, it takes time to run its course. So
Okay.
which then it's a roundabout way of saying, well, hang on, what would cause deterioration in credit quality? Well, it would be recession. So all roads lead back to recession on that front.
Okay. And
Mm,
do you think one of the major signs are how defensive assets, you say they're seasonal, that they rise in seasonally,
mm,
September, October are,
mm,
infamous. But could it be
mm.
a bigger shift in money flows
Yeah.
going
So
to
if I look at
because of what you're talking about here?
mm,
Even though you're not going to come out here with a sell signal, you
mm,
have a lot of caution, and people
mm,
with big money to move around can't do it in an hour. They have to
exactly.
do it over the course of time, or
Yeah.
they'd move markets, right?
Yes. So the thing with defensives is when I talk defensives, I'm talking healthcare, consumer staples,
Right.
utilities,
Yeah.
REITs to a certain extent as well. But that basket of stocks are basically trading at the third cheapest level on a relative basis to the index in history. And so that extreme undervaluation, it already makes you want to pay attention. And then at the same time, investor allocations to defensives are at record lows. Market cap weighting of defensives are at record lows as well. And so, that's just like that's this makes a contrarian investor's mouth water, that kind of situation. And so, that starting point is quite
There's a
interesting.
value buyer,
Exactly. But
right? Yeah.
from a seasonal standpoint, the time that the defensives do tend to do well is during these troublesome months. But that's yeah, it's almost a mirror image of the usual stock market seasonality that you see, which is the
Right.
market tends to do not so well this time of the year, and so that can be a good time for a turning point in these larger cycles there. And so I think the thing that stands out to me on defensives is, if you're sitting there with kind of a bearish bias, that we're at late in the cycle, that there are these risks, then you think about, okay, what are the diversifiers that we should be looking at? What are the hedges that we should be looking at? And I always think, okay, we want to be smart with diversifiers because back on the correlation point, correlations change. And back in 22, bonds did not perform very well
No,
as a
no,
diversifier
they
because
were
they
they
were
turned into a
expensive.
risk. They turned
Yeah,
into a risk asset, just another
exactly.
risk asset. Yeah.
But by my metrics, late 21, they were extreme expensive. And so, if you're thinking, okay, what diversifier can I look at? If it's expensive, then probably it's not the first on the list. If it's cheap, then it starts to look a lot better. And actually, bonds are looking cheap now. Even with that move, they're still cheap on my indicators. But
Okay.
defense is definitely cheap, so they tick that box as well. Um, Gold, not so much by itself, but if you look at the drivers of gold, turn it on its head, the US dollar being expensive, then that's kind of cheap for gold because if the US dollar weakens, and that helps gold. And then bonds also, if you think the bonds are cheap, then that means that by definition you think yields are ultimately going to go down. If that happens, that helps for gold as
Where will
well.
gold be when the Dixie is 88?
Ooh. Well, back to correlations, that depends.
It maybe gold goes down because there's another way to go
Well,
besides
yeah,
gold.
yeah. Um,
No,
I mean, we
the
can't,
gold could go up with the dollar going up. Why can't gold go down with the dollar going down?
and that's right, we can't get too many steps ahead of ourselves because if you go out and start forecasting too far into the future, you know, then you kind of can get a little bit of a,
Yeah.
when you stall your car, if your engine's running pretty quickly and then try to change your gear, then it's like we've got to put one foot in front of the other, and yeah.
Yeah,
So
I had friends early in my trading career that would say, Dale, you really like to hear the ice crack. It made me feel alive. And
yeah,
anyway, Callum, why don't you tell the people about ChartStorm? And I
yeah,
see you, talk about it on LinkedIn and
mhm,
top-down charts, how they could follow you. And
yeah.
I love your demeanor. You're
Oh, thank you.
calm, at least on the outside,
Yeah.
talking about things that make people jittery. And I've seen your technical work before. It's very good.
Thank
And
you.
I think that you could help a lot of people avoid
Mm,
landmines. Uh, do you also, I know you talk to funds. Do you have a
mm.
service for retail traders?
Yeah, definitely. That's what we're looking at the moment. The
Okay.
chart storm there. That's probably the best place to go. That's
Where is it?
something.
How did they
Oh,
find it?
so if you Google weekly chart storm, you'll probably make your way there. Or if you
Okay.
go to www.chartstorm.info, that's the website for it.
Okay.
And that's something I put out every Sunday my time, but every Saturday afternoon your time. And that's basically looking at a mix. So we've got the latest one here, a mix of what's happening, taking the pulse of the market with the technicals, looking at where flows and sentiment are tracking, macro or cycle kind of stuff, positioning, Fed kind of issues there, sort of larger, background issues of where the market is, and even some sort of long-term historical things like going back and looking
Oh
at
yeah.
the Newton's nightmare
I
and
was his broker. I'm kidding. Anyway, yeah, Newton.
exactly. Yeah.
He found out, you would think a guy like that would know that after a parabola, you
Mm.
have a collapse, right? Because
Yep.
he was, discovered gravity,
Grab.
and he
That's a
lived,
perfect
and he lived
example of
it.
gravity.
Man,
Yep.
he lived that gravity lesson. It was a
Yeah.
pleasure meeting you. It's kind of a reunion because you said the last
Yeah.
time we talked was about seven,
Yeah.
8 years ago.
Yeah. Yeah.
Let's not let that kind of time pass. And
Yep.
I wish you a lot of success to continue to grow
Thank
with
you.
ChartStorm. And
Mm.
I had a great time talking to you. And I
Yeah,
sense your
absolutely.
caution, and I'm going to keep in touch with what you're thinking.
Thanks.
Appreciate
Yeah.
you granting the interview, Callum.
Yeah, appreciate it. It's been a good chat.
You're my trading warrior brother now
Yep.
for life. You
Thank you.
got through it. You get through an interview with me. You're my trading warrior brother,
Haha.
and that's like joining the mafia. You can't leave it. So, uh, thank you, and get that guest house built in your backyard so that
Yep.
when everything the what hits the fan, I
Yep.
could come out and learn from you and
Yep.
watch the
100%.
U.S. on TV and instead of being in the middle of it.
Yep. 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 Sounds good.
All right, Callum Thomas, everyone. Follow him on X at Callum_Thomas and check out his work. He's you know, I find the best guys in the business, technicians, spend a lot of time putting a lot of work and effort into their analysis for you. You can't be lazy and be good in this
Mm,
industry. Thanks again,
100%.
buddy.
Thanks.
Or as you guys say, thank you, mate.
Oh, it's bro down here. Mates
Oh, is
Australia.
it bro?
Yeah.
Oh, well, then I fit right in then, man. I'm from Chicago, and that's what I call my friends. So,
Yeah.
all right, bro. Great talking
Yeah.
to you.
Yeah.
Thank you, Callum.